Welcome back to the Mindset Masterclass channel, where we discuss investing, entrepreneurship, and personal finance. Today's video is all about the do's and don'ts of investing. We wrote this list with stock market investors in mind, but many of the points are relevant to crypto investors too. Rule number 1. Don't invest money you can't afford to lose. With every penny invested, ask yourself if you're comfortable with the fact you might never see it again. You should earmark a certain percentage of your income for investing and stick to it. Don't make the mistake of compromising your well-being. For example, using the money you'd put aside for rent or groceries to buy stock, regardless of how sure you are the price will rise tomorrow. Nothing is certain in investing, so don't put yourself in a position where you can't pay for necessities because you bought stock. You'll probably want to avoid having to tell your kids they can't have new school shoes because you invested your money into a random tech stock that went to zero. Rule number 2. Get educated. Some of the things you should learn about are how to understand yields and return on investments, how to read company accounts, and how to understand cash flow forecasts. Yes, they sound dull, but are absolutely essential to long-term investing success. Don't limit your education to simply learning about the process of investing. For example, you should learn about basic macroeconomics, taxation and spending, interest rates, and unemployment policy. These functions of government play a huge role in an economy and can significantly impact supply and demand, and thus the profitability of a company and the performance of your investment. You don't have to pay a fortune for education. There are so many free resources out there which can teach you the basics and beyond of investing. Don't be fooled into thinking that you need to pay $997 to some self-styled guru to learn stuff that's already on YouTube for free. There are some fantastic books available about investing. I'll list some of my favorites in the video description. Don't think that just because you've read one book on investing that you should leave it at that. Education is a lifelong process. You should always seek to expand your knowledge. I still read books on investing 10 years into my journey, and I don't plan to stop until I'm at least as successful as Warren Buffett. Education is ongoing, but don't get paralyzed by the fear of getting started. If you're not confident yet, perhaps try with just a small amount of money and learn as you go. The truth is, there is no such thing as being fully educated. We do not have perfect knowledge, so there's no point in delaying your investment journey because you're not an expert yet. The third golden rule: research your investments. Don't be the person who YOLOs their entire life savings into a stock or coin that you read a post about on a subreddit written by an excitable teenager, claiming a certain coin is going to the moon. Do your own research. Not only should you learn about a specific company's products or the benefits of a certain technology before buying in, but research the management team or board of directors. For crypto investors, I'd suggest you look into the development team. Find out what projects they've worked on in the past. Don't rely on past performance as an indicator of future performance. You can't assume that history will repeat itself. Just because a stock or coin has increased in value over a certain time doesn't mean it will continue to. You should use historical prices as one of many indicators. Investing has its risks, but these risks are limited if you perform thorough research. Investing without research isn't investing at all. It's speculating. Hoping to get rich from buying stocks you don't really understand is not really any different to buying a lottery ticket. It's gambling. Just because you've read up on a stock or industry before you invest doesn't mean you should stop doing your research. Stay on top of the news surrounding that investment in case anything changes which might impact the share price. Learn about a company's rivals, its suppliers, the legal system in the country it operates, and anything else which might influence the company's operations. Read the financial news to keep up to date with what's going on in the economy. Rule number 4. Keep your investment portfolio diversified. This should be diversification between multiple asset classes, market sectors, and holdings. Essentially, don't put all your eggs in one basket. Don't be tempted to go all in on a meme coin someone tweeted about or a stock you read about on Wall Street Bets, only for it to collapse weeks later, leaving you with a fraction of your investment. Within your stock market portfolio, you might want to hold shares in companies operating in different industries or locations. This way, you minimize the risk of losing your entire investment capital. If you're only invested in one stock and that company goes bankrupt, you could lose all your capital. This is why many investors make use of exchange-traded funds or ETFs, which give you exposure to multiple stocks in one investment product. Golden rule of investing number 5 is don't follow the herd. In the stock market, renowned investor Warren Buffett once said in a letter to shareholders, "Be fearful when others are greedy and greedy only when others are fearful." This could be interpreted to mean that if investors are getting excited about a stock and the price is rising, you should be cautious about buying, as a dip in the market could occur and the price may fall. Conversely, if people are selling a stock and the price is on a downward trend, this may be an opportunity to buy shares in that stock, as you could stand to make a profit should its price eventually recover. Of course, this is all subject to you conducting your due diligence and ensuring the fundamentals of the company meet your investment criteria. Don't pay too much attention to the noise. Yes, you should pay attention to what's going on in the world, particularly anything which could impact your investment. But there are plenty of external commentators who will tell you a certain stock or coin is going in a particular direction. You have to ask what their motivation is. Are they trying to talk up the price of a stock because they hold it and want to sell? Or perhaps they're just trying to force a stock's price to fall so they can buy more at a discount. Just like tabloid newspapers and gossip columns, there are news sources who will publish attention-grabbing stories with titles which might make you panic. Often these blogs or websites have some sort of product or premium feature they want you to pay for and use sensationalist content as a way to lure you in. Long-term investors pay little attention to short-term price fluctuations, and the wisest investors will have researched the stock prior to investing. If you believe in a company's fundamentals for the long term when you invest, you would have no reason to panic if a share price drops in the short term. The 6th rule on our list: know when to cut your losses. The classic throwing good money after bad fallacy. You've lost money on an investment, so in an attempt to make it back, you buy more of the stock or coin only for it to lose even more value. One of the most enduring sayings on Wall Street is, "Cut your losses short and let your winners run." Wise advice, but many investors often do the opposite, selling stocks after a small gain only to watch them head higher, or holding a stock with a small loss only to see it lose even more. No one will be deliberately buying a stock that they believe will go down in price and be worth less than what they paid for it. However, buying stocks that drop in value is an inherent part of investing. The objective, therefore, is not to avoid losses, but to minimize losses. Realizing a capital loss before it gets out of hand separates successful investors from the rest. Golden rule number 7. Don't obsessively check your portfolio. We've all been there, and I'm certainly no exception. I have in the past been guilty of checking my apps not just daily but hourly. Some investors might be tempted to check their apps every 20 minutes. This is not healthy if you're a long-term investor. You should be confident in the stocks you pick for the long term, so what's the point in checking every day? You could use that time to spend researching other stocks or doing something which can earn more money to invest into your portfolio. The 8th essential rule: choose a strategy and follow it. Are you a long-term or short-term investor? Are you interested in quick gains or long-term growth? If you're simply looking to make a quick buck, then perhaps short-term trading might be for you. But if you're interested in creating lasting wealth, perhaps a fund to retire on, then you'll be thinking long-term. The key here is to make sure that when you buy an investment, you know how long you plan to keep it for. Many stock market brokers these days offer a share dealing service for free or for very little commission. You need to consider any fees or commission paid to your broker, not just for when you buy a stock, but when you sell it too. A fee to purchase a stock which you plan to hold for many years might be negligible compared to the potential increased value over time, but fees paid on stocks you trade can quickly add up and cause your strategy to be unprofitable. Rule number 9. Take security seriously. Regardless of if you're buying stocks or crypto, make sure you use a broker or exchange which is reputable and has security features. Two-factor authentication is a must regardless of the size of your portfolio, but especially when you have a lot of money invested. For cryptocurrency, I recommend you buy a hardware wallet, which is a plug-in device that holds the digital keys to your crypto holdings. It's much safer than leaving your investments on an exchange, which could be compromised by fraudsters. See the video description for a link to my favorite crypto hardware wallet. Finally, golden rule number 10. Don't treat your stock or crypto portfolio as a way to generate an income. This is especially true for those of you who might be just starting out in their career or investment journey. Treat your portfolio as a way to preserve and grow your existing wealth earned from your business or job. We recently posted a video discussing this concept in great detail, so I suggest you check it out. Savvy entrepreneurs already know that the best way to generate income is through passive income sources. They then either reinvest this into their business ventures or into their portfolios. Don't make the mistake of thinking that dividend payments on stocks bought with a fraction of your wages are going to replace your day job income anytime soon. Your portfolio can be a great tool to build wealth for the future, but it would take a lot of upfront investment to generate the sort of money you could retire on anytime soon. If you've enjoyed this video, consider subscribing to the Mindset Masterclass channel so you don't miss any of our videos on investing, entrepreneurship, and personal finance.